Thanks for tuning in to your daily dose of quick real estate updates, local housing trends, and market data, plus tips, tools, and strategies to help you buy, rent, or invest with confidence. You're now getting ready with RealiCare Reports, powered by the innovation team, Cami and Rex. Now go grab your favorite morning breakfast, coffee or tea, and let's enjoy today's episode.
Welcome to the deep dive. Okay, let's just imagine for a second. It's that scenario you hope never happens. A disaster hits, your home, gone, completely destroyed. You might think, okay, awful, but the insurance payout, that'll cover the mortgage, right? Wipe the slate clean. Well, here's the thing. The real kicker that catches so many people out, that mortgage, it often sticks around. You're still on the hook. So today's deep dive is all about getting you ready for that before it's ever a reality. We're digging into a really helpful article, Mortgages After a Disaster, What to Expect, by Kate Wood over at Florida Realtors.
Exactly. And our goal here is pretty simple. Shift from that understandable anxiety to, well, action. Knowing the steps now can save you unbelievable stress later. I mean, Brittany Panetta, who's worked with folks after major wildfires, she notes that families who've lost everything, they just don't have the mental bandwidth, the capacity to deal with complex financial stuff.
Absolutely. Okay, so the worst has happened. Your house is gone. What's the very, very first call you need to make? Is it insurance? FEMA?
Actually, no. The first absolutely critical step is you have to notify your mortgage servicer.
The servicer. So the company you actually send the payments to.
That's the one. Might be your original bank, might be someone else who bought the loan. You got to let them know immediately.
And why is that so critical? I mean, amidst the chaos, wouldn't that slip down the priority list? Is it just like a courtesy?
Oh, it's definitely not just a courtesy. It's actually mandatory. It's baked right into most home loan contracts.
Really?
Yeah, there's usually a clause saying you must inform them about a major loss. Think about it. They have a huge financial stake in that property.
Ah, right. They're collateral.
Exactly. So that notification is step one, and it really shapes everything that comes next. Skipping it could technically put you in default, which is the last thing you need.
Okay, that makes total sense. So you've made that call. What's next? Is there any immediate help for the payments themselves?
Yes, and this is crucial. You need to ask about forbearance.
Forbearance. Heard the term, but what exactly does it mean in this context?
It's basically a temporary pause button on your mortgage payments. The servicer agrees to let you skip payments for a set period, usually a few months, sometimes longer, depending on the situation.
Okay, a pause. So no late fees, no credit score hit.
Generally, no. That's the huge benefit. It stops the immediate financial bleed from the mortgage. But, and this is really important, it's not forgiveness.
Right, not free money.
Definitely not. You will have to make up those missed payments later. How that happens varies. Maybe a lump sum, maybe extending the loan term, maybe higher payments for a while.
Gotcha. But that immediate breathing room, I imagine that's invaluable when you're suddenly paying for hotels, food, everything else.
Invaluable is the word. It frees up cash when you desperately need it most.
Okay, so you've notified the servicer. Maybe you've got forbearance sorted for a bit. Once the dust settles, just a little. Homeowners face this enormous decision, don't they, about the future?
It's a massive fork in the road, and often comes when you're least emotionally equipped to handle it. Jennifer Beeston, she's worked with wildfire victims. She really nails it.
What does she say?
She says, "This is a horrible emotional time, but unfortunately, it's also one of those times where really understanding the math, looking at your options, weighing pros and cons, is critical."
Understanding the math when your life's just been turned upside down. Wow.
It's incredibly tough. But those mortgage documents, complex as they seem, usually boil things down to two main pathways forward using that insurance money.
Which are?
Path one, you use the insurance funds to rebuild your home. Path two, you use the funds to pay off the existing mortgage and, well, walk away.
Okay, let's break down path one first, rebuilding. What does that actually involve with the lender?
Well, first, as we said, they know about the loss. Then you and the lender need to agree on how the insurance payout gets handled.
Agree.
Yeah. And if you're rebuilding, the general rule is the new place needs to be pretty comparable in value to the old one.
Okay. Now, I've heard something about this insurance payout that surprises people. Does the lender actually take control of the check?
They often do, yes. This is a big one that catches homeowners off guard. The lender typically manages those insurance funds. You might even have to endorse the insurance check over to them.
Wait, really? Even though it's my insurance policy? Why?
It sounds counterintuitive, I know.
Mm.
Beeston mentioned folks from the Tubbs fire were, understandably, really angry about it. Felt like losing control.
I can imagine.
But it's standard practice across the industry. Remember, the lender needs to protect their investment. They want to ensure that money actually goes into rebuilding the house, their collateral.
So how does that work? They just hold on to the cash?
Usually they put it in an escrow account and release it in stages, like draws, as different phases of the construction are completed and inspected.
Okay. Adds another layer of complexity. And all this time, while you're rebuilding, maybe living somewhere else, you still have to make those original mortgage payments, right?
Right.
For a house that isn't even there.
That's usually the case, yes. Unless you have that forbearance, the payments continue. It can feel like a double hit, paying a mortgage on rubble and paying rent somewhere else.
So how do people manage that? It sounds financially crippling.
This is where another part of your homeowner's insurance is absolutely vital. Loss of use coverage.
Loss of use.
Yeah, sometimes called additional living expenses or ALE. It's standard in most policies. It's designed specifically to cover those extra costs you incur because you can't live in your home, rent, hotel bills, even things like extra mileage or restaurant meals if you don't have a kitchen.
Okay, so that's a crucial piece. Is FEMA ever part of that picture?
It can be. FEMA housing assistance might offer some support too, depending on the specifics of the disaster declaration and your situation. It's definitely something to look into.
Right. So rebuilding is complex, lender involvement, ongoing payments, but loss of use helps. What about the other path? Just taking the insurance money and paying off the mortgage. Seems simpler?
It might seem simpler on the surface, but here's another potential nasty surprise, a really significant one. Insurance policies often have different payout structures depending on what you do with the money. They might pay out significantly less if you just take the cash to pay off the loan compared to what they'd provide for actually rebuilding.
Less. How much less are we talking?
It can be a huge difference. Brittany Panetta gives this powerful example. Your policy may say you're insured for $500,000 if you want to pay out, but up to $1 million if you want to rebuild?
Wow, half. Just because you choose not to rebuild.
Exactly. It's a massive discrepancy in value. And with rebuilding costs being what they are today, just taking the smaller payout often means walking away with very little or even still owing money after losing all your equity. It makes that payoff option much less attractive for many people now.
Okay, this is a lot to think about. It really highlights things you just wouldn't consider until you're in the thick of it. So for everyone listening now, thankfully not in that situation, what does this all mean? What can you do proactively?
That's the key takeaway, isn't it? You can't control the disaster, but you absolutely can control your preparedness. And the article points to 2 really concrete steps.
Okay, what's the first one?
Access to information. Simple, but vital. Make sure you can easily get your hands on your key mortgage details, the loan number, who your servicer is, their contact info, maybe even a copy of the loan docs themselves.
So not just relying on paperwork filed away somewhere that could be destroyed.
Exactly. Think digital. Secure cloud storage, a password-protected file on your phone, maybe a secure app, something you can access even if you're evacuated and only have your phone. Forget relying only on that fireproof safe.
Good point. What else on the info front?
Document your budget and regular expenses. Keep records. This is absolutely critical if you need to file that loss of use claim we talked about.
Why? How does that connect?
Because that loss of use coverage is often calculated based on your normal standard of living. They need to know what your usual costs are: rent or mortgage, utilities, food, transportation, to figure out the additional expenses incurred because you're displaced. No documentation makes that claim much harder.
Okay, access key info digitally, document your normal expenses. Got it. What's the second big preparation step?
This one's maybe a bit more involved, but arguably even more important. Reevaluate your homeowner's insurance.
Insurance. Most people get it when they buy the house because the lender makes them and then kind of forget about it, right?
That happens all the time, and it's a huge risk. Yes, the lender requires it, but the minimum they require might not be enough for you.
What should people be looking for?
2 main things. First, is your dwelling coverage limit high enough to actually rebuild your home at today's construction costs? Costs for materials and labor have gone way up. What covered you 5 years ago might leave you way short now.
So not just the market value of the house, but the actual cost to rebuild it.
Precisely. And second, do you have the right kind of disaster coverage for where you live? Standard policies often exclude things like floods or earthquakes. You might need separate policies or endorsements for those specific risks. Don't assume you're covered for everything.
Really need to read the fine print and talk to your agent.
Absolutely. Understand your limits, your deductibles, and crucially, what perils are actually covered.
So wrapping this up then, the core message seems to be that doing these things now, getting your info accessible, understanding your expenses, reviewing your insurance, it doesn't prevent disaster, obviously, but it gives you tools, resources, maybe a little bit of control back if the worst happens.
Exactly. It turns that feeling of helplessness and anxiety into, well, actionable knowledge. It provides some reassurance. And maybe here's a final thought to leave you with. We see these disasters in the news more often. Insurance is getting trickier and more expensive. How might taking these steps, really understanding these worst-case financial scenarios now, not just protect your wallet, but actually change how you feel about your home, your security? Well, maybe that knowledge itself, even about tough subjects like this, becomes its own form of resilience, a different kind of foundation for your peace of mind. Something to think about.
Well, that wraps up today's episode of Reality Reports, where real estate meets real life. For more updates, tools, and insights that will help you buy, rent, or invest with confidence, be sure to follow, subscribe, stay connected, stay informed, and stay ready. Until next time.